Hi, this is Nick Seidel with your weekly market update. And since it's the holidays, don't worry, I'm not here to raise your rates, just your awareness. Delayed government data this week showed inflation continuing to cool, while the labor market is quietly softening, even if the headlines don't fully capture it yet. The Consumer Price Index, or the CPI, came in softer than expected. Headline inflation eased to 2.7% year over year, down from 3%. Core inflation, which excludes food and energy, fell to 2.6%, its lowest level since early 2021. One of the most important details, especially for the housing, is the shelter costs finally started to cool. Shelter has been most stubborn part of inflation in the CPI numbers, and it usually lags real housing market conditions. So, what buyers and sellers have already been feeling on the ground is now showing up in the data. On the labor side, the story isn't just numbers, it's job quality. Payrolls declined by 105,000 in October, followed by a modest rebound of 64,000 jobs in November. Even so, the unemployment rate has climbed to 4.6%, up from 4.1% just a few months back. More telling, nearly 1 million full time jobs were lost, while over 1 million part time jobs were added. That's usually a sign that businesses are cautious and households are tightening spending. Taken together, the Federal Reserve is balancing cooling inflation against a softening labor market. Historically, when those two forces move this way, monetary policy tends to follow, but it's not an overnight thing, but directionally over time. What does directionally over time even mean in plain English? It doesn't mean mortgage rates drop next week, and they're not even linear. It means the pressure shifts away from rate hikes and towards eventual easing, or in our case, rates going down. Mortgage rates tend to move ahead of the Fed, so even before official cuts happen, we often see better pricing days, rate dips, and opportunities to act strategically. In broader markets, major stock indices have been trending higher as inflation expectations ease and confidence improves. Seasonally, this is also the period often associated with the Santa rally, fingers crossed, when markets tend to strengthen into the year end as liquidity and optimism returns. That means because when markets stabilize, capital starts looking for opportunity again, and real estate is part of that conversation. Turning to housing, existing homes closings rose 0.5% in November, marking the third month with straight gains. Investors fell nearly 6% month over month, largely due to seasonal pullback, not collapsing demand. Builder confidence has edged higher, but higher costs and uncertainty are still keeping supply tight. For buyers and homeowners, this is a market where strategy matters more than headlines. I want to leave you with a little thought and a little quote. Then the Grinch thought of something he hadn't before. What if Christmas, he thought, doesn't come from a store? What if Christmas perhaps means a little bit more? If this was helpful, tap like. Share it with someone who's navigating the market right now, and follow for weekly updates that go beyond the headlines. Thank you.